going on, everybody? Chris here from projectoption, and in this video we're going to talk about the VIX Index. Now the VIX is one of the most commonly watched indicators in the market because the VIX tracks the option prices on the S&P 500 index, which is one of the most actively traded products in the market. So let's do it. So what is the VIX Index? Well, the VIX Index was created by the Chicago Board Options Exchange, and it tracks the 30-day implied volatility of the options on the S&P 500 index. And the S&P 500 index has the ticker symbol SPX. So since there's not a 30-day expiration cycle on each trading day, the CBOE actually uses expiration cycles for SPX options that expire between 23 and 37 days. So using those expiration cycles, they look at all the options in each expiration cycle and they come up with an implied volatility number for each of those expiration cycles. Then they use a weighted average between those expiration cycles to come up with a 30-day implied volatility number, and that is what the VIX index itself represents. So why would anybody want to know the implied volatility of the S&P 500 index options? Well, many people regard the S&P 500 as the best representation of the U.S. stock market overall, and additionally, the SPX is one of the most actively traded products out there. So people want to keep track of the option prices on that most actively traded product. Additionally, the VIX is sometimes called the fear gauge or the fear index because option prices tend to rise in times of market turbulence. So when the SPX collapses or when the S&P 500 collapses, option prices on the SPX tend to rise because more people are hedging their positions and more people are willing to pay higher premiums for options because they're expecting the market to be more volatile. So knowing the VIX number is an indication of overall market sentiment. So when the VIX is really low, that's an indication that the market is very complacent, and when the VIX is extremely high, that's an indication that there's a lot of fear in the marketplace. Now, another point I'll mention is that when the option prices on SPX are cheap, there's a good chance that most stocks in the market have low option prices as well. Not all of them, but the VIX will be a good indication as to whether or not option prices in other equities are cheap or expensive as well. So in fact, as I'm recording this video, the VIX index is right around 11.5, which is extremely low. The VIX has only gone as low as 9.5 or so, so 11.5 is really on the low end of where the VIX index has been historically. So another reason people are interested in the VIX is because it helps them select appropriate strategies for that current market environment. So when option prices are cheap, the VIX is low, and people sometimes prefer to focus on net long premium strategies because those strategies benefit from increases in implied volatility. On the other hand, when option prices are expensive, the VIX is high, and people prefer to focus on net short premium strategies because net short premium strategies profit when volatility falls. So now that you know the basics of what the VIX index represents, let's go ahead and just visualize the changes in the VIX index through time. So the graph here is just the VIX index closing prices from November 2015 to November 2016. So as we can see here, in November of 2015, the VIX was just below 15, and in a few short months it rose to 27.5. And then from there it fell back down to around 12.5, then rose back to 27.5, and then fell back down to below 12.5. So as we can see here, the VIX is always changing from a day-to-day basis, and that just means that the option prices on SPX are changing on a day-to-day basis. So why does the VIX, or why do SPX option prices fluctuate so much? Well, one of the drivers of changes in the VIX and changes in option prices are changes in the stock price, so price action. When the market falls, the VIX tends to rise because more people are buying SPX options for protection, and people are willing to pay more for speculative purposes because they're expecting the market to be more volatile. Now, a change in the VIX is not always caused by price action, but upcoming news events. So if there is an upcoming news event that could potentially move the market in a big way, then people are going to be implementing speculative positions or hedges because they don't like the uncertainty of that potential market move. So aside from representing the option prices on the SPX, the VIX Index actually represents the one standard deviation expected range for the S&P 500 over the next year. So the VIX Index is expressed as an annualized percentage, even though it uses option prices that are between 23 and 37 days to expiration. So here we have a formula to calculate the expected range of the S&P 500 for a one-year period. So to calculate that, we just take the S&P 500 price and add or subtract the S&P 500 price times the VIX divided by 100. So we're just converting the VIX index value into a percentage. So for example, if the S&P 500 is trading for $1,500 and the VIX is 10, the one-year expected range is plus or minus 10% in the market. So therefore, with the $1,500 S&P 500 price, the one-year expected range would be 1,350 to 1,650. So that's plus or minus 10%. Now, if the S&P 500 price is 2,000 and the VIX is 30, that represents a one-year expected range of plus or minus 30%. So in that case, the one-year expected range would be between $1,400 and $2,600. Now, if the VIX were 50, that represents a 50% one-year expected range. So in that case, the one-year expected range for the S&P 500 would be 1,000 to 3,000. So either it gets cut in half or increases by 50%. So since these expected ranges are one standard deviation ranges, that means that these ranges are the 68% probability ranges. So for example, with the VIX at 50 and the SPX at 2,000, the 50% expected range is just the 68% probability range. So basically it's saying with the SPX at 2,000 and the VIX at 50, there's a 68% chance that the S&P 500 will be between 1,000 and 3,000 over the next year. And that means there's a 32% chance that the SPX is below 1,000 or above 3,000 in 1 year. So we talked about this briefly before, but there's a very understood and very well documented relationship between the VIX index and the S&P 500. So when the S&P 500 falls, the VIX tends to increase because more people are buying SPX options for speculative purposes or to hedge off the risks of positions. Now, when the S&P 500 rises or remains flat, the VIX tends to decrease because, wild market movements are no longer occurring, and when stock prices are rising, people are happy and complacent, and there's no real need to go out and buy protection in a hurry. So therefore, in that scenario, the VIX tends to decrease. So let's go ahead and look at a visualization to back up this concept. So in this graphic, we're just comparing the S&P 500 price on the top graph to the VIX index in the middle graph compared to the one-year expected range, which is on the lowest graph. So this time period is between November 2015 and November 2016. So as we can see, we have two shaded regions of this chart. So in shaded region A, which is the first shaded region, we can see that the S&P 500 is trading relatively flat, but then it collapses from nearly 2,100 down to 1,850. Over that same time period, the VIX increases from 15 to almost 30. So the VIX doubles when the market falls. And as we can see on the bottom graph, the one-year expected range when the VIX is at 15 is just below 350. However, when the market falls and the VIX rises to almost 30, that one-year expected range rises to about 500. So the expected stock price range when volatility increases can increase significantly. Now, in shaded region B, the market starts off around 1850 and steadily rises to around 2050. Now, in that same period, the VIX index falls from about 27.5 down to 15 again. So as we can see, rising market, falling VIX. And in terms of the one-year expected range, the one-year expected range also falls because the VIX is falling. So to make a long story short here, when the market falls, the VIX tends to rise, and when the market rises, the VIX tends to fall. So to hammer that point home, we ran the 1-month correlation between the VIX index and the SPX index over that 1-year time period. So as we can see here, most of the time the index or the correlation between the VIX index and the SPX index is well below negative 0.80. Now a correlation of -1 represents a perfect inverse relationship. So to have a relationship consistently below negative 0.8 means that there's a strong inverse relationship between the two products, and that's exactly what we're seeing here. Alright, now it's time for a little history lesson. So this chart here is showing the VIX Index closing values from 1990 to 2016. So the lowest closing value was 9.31. The average closing value is 19.69, so just about 20. And the highest closing value was 80.86 in 2008. So as we can see here, most of the time the VIX Index is actually below 20. So since 1990, 61% of the VIX closes have been below 20. However, as we can see, there have been many times where the VIX Index spiked very violently in a short period of time. And that's pretty common. When the market collapses, it tends to do so very violently, which leads to very, very quick increases in the VIX Index. So now let's look at the VIX by the numbers. So here we have the different percentiles for the VIX Index values since 1990. So a percentile just shows the percentage of the time that the VIX Index was below a certain price. So the 90th percentile of 28.94 means that 90% of the time the VIX Index was below 28.94. Now if we go on the other side, the 10th percentile is 12.22, which means 10% of the time the VIX Index is below 12.22, which means 90% of the time it's above 12.22. Now the 50th percentile is 1782, which means half the time the VIX Index is above 1782 and half the time the VIX Index is below 1782. So that 1782 number is kind of the middle ground for VIX Index values since 1990. Well, that wraps up some of the most important concepts you need to know about the VIX Index. So now let's go ahead and recap the main concepts you've learned in this video. So first, the CBOE's VIX Index tracks the 30-day implied volatility of the options on the S&P 500 Index, or SPX. The VIX Index is sometimes referred to as the fear index or the fear gauge because as the market falls, the VIX tends to rise, and when the market rises, the VIX tends to fall. So the VIX number actually represents the one standard deviation range for the market over the next year, and the VIX is expressed as an annualized percentage. So as I just said before, when the market falls, the VIX tends to rise, and when the market rises or trades flat, the VIX tends to fall. And lastly, since 1990, 61% of the VIX closing prices have been below 20, but as we've seen, when the market does collapse, it tends to do so violently, which leads to very, very significant and quick increases in the VIX Index. Thanks so much for watching, everybody. If you enjoyed this video, please subscribe to our YouTube channel so that you can get all of our videos as they come out in real time.